Today, more anti-inflation rate tightening. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the tightening continues as the Bank of Canada joined the party once again and delivered a fourth consecutive outsized interest rate hike in a bid to slow the nation's economy and drag inflation down from 4-decade highs. The Bank of Canada's decision was a statement only of fare with no new forecasts. Policymakers, led by Governor Tiff Macklem, raised the benchmark overnight rate by 75 basis points to 3.25% on Wednesday, giving Canada's central bank the highest policy rate among major advanced economies. Officials said they expect to continue raising rates in coming months. The 75 basis point rate hike leaves Canada with its highest policy rate since 2008 and brings borrowing costs to a level the Bank of Canada believes will start to actively cool the country's economy, the so-called neutral range of rates, which neither stimulates nor restricts activity, is estimated to be between 2 and 3%. The rate increase follows a surprise 100 basis point hike in July and half-point moves in April and June, making the current tightening effort one of the most aggressive ever. The overnight rate sat an emergency pandemic low of 0.25% until the beginning of March. The central bank reiterated its commitment to bring consumer price gains back to a 2% target, and officials said they remain worried that persistently elevated inflation risks becoming entrenched in the expectations. While noting headline inflation eased in July on a drop in gasoline prices, policymakers pointed to a broadening of price pressures and increasingly sticky core measures. Officials flagged slower than expected economic growth in the second quarter, but highlighted very strong indicators of domestic demand, including consumption and business investment. As mortgage rates climb, the bank said Canada's housing market is pulling back as anticipated, following unsustainable growth during the pandemic. That suggests officials aren't yet worried by what the Royal Bank of Canada has described as a historic real estate correction that has seen benchmark prices in the financial capital of Toronto fall 16% from their peak in March. The debate now moves to what the next steps will be for Macklem as the central bank tries to assess how high borrowing costs will need to rise to tackle sticky inflation. Markets are pricing in a strong chance of another half percentage point increase in October. The truth is, sticky core inflation, a tight labour market, and the lingering risk of an unfavourable wage price spiral points to further rate hikes in coming meetings. Many are expecting a peak of 4% by the end of the year. As the effects of tighter monetary policy work through the economy, we'll be assessing how much higher interest rates will need to go to return inflation to target, the bank said. Given the outlook for inflation, governing councils still judge that the policy interest rates will need to rise further, they said. For those asking, are we there yet? The Bank of Canada answered, not yet. Avery Shenfield, chief economist at Canadian Imperial Bank of Commerce, said in a report to investors. The bank is signaling today's outsized rate hike still leaves rates shy of where it believes they will need to be to quell inflation. And the Bank of Montreal chief economist Douglas Porter noted that the Bank of Canada would likely not be pleased to see the Canadian housing market stabilise or even revive anytime soon, after Toronto home sales bounced 11% in August from the previous month. While benchmark prices continue to drop, the jump in activity could be a sign that the market slide is easing amid rising interest rates and an uncertain economic outlook. Any sign that the most interest-sensitive sector of the economy is holding up surprisingly well will be a clear signal that more tightening than expected may be required. Another reason Macklem may have to go higher is that tightening cycles typically need to see rates rise above core inflation, currently more than 5%, to fully crack persistent price pressures, Porter said. Nominal gross domestic product and income growth are also on a rampage, he added, and modestly restrictive rates may not be enough to douse that fire. Yields on Canadian government 2-year bonds rose slightly on the statement, up 1 basis point to 3.62%, and the Canadian dollar was little changed, down 0.3% to 1.3183 per US dollar. Wednesday's move will also cement Macklem's reputation as one of the more hawkish central bankers among his peers. Monetary authorities around the world are slamming on the brakes to halt a post-pandemic surge of inflation. The RBA raised its policy rate by half percentage points on Tuesday, as Banco Central de Chile also stunned investors with 100 basis point move. The European Central Bank is poised to deliver a 75 basis point hike on Thursday, and the US Federal Reserve meets later this month with an increase of at least 50 basis points expected. The rate hike, pass-the-parcel, is therefore going to continue for some time, which begs the question, at what point will the music stop? Given the embedded nature of the inflation shock, it's probably more a symphony than a song. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.